Ethan Harris of Bank of America Merrill Lynch joins us on the phone line from New York. Well, Ethan, first up, how should an emerging market investor read the Fed's cues? In the morning today, Asian markets and the emerging markets are marginally higher. It's not a runaway rally. Should we expect that we are not going to see a return of funds to EM markets?
Well, I think that the message from the Fed move today is a positive one in the sense that, you know, I think global markets have been waiting a long time to see the Fed move, and there have been a lot of concern when the Fed delayed their rate hikes because there's a sense that the Fed had so little confidence in the U.S. economy, it was unwilling to move. So I think that now that the Fed has hiked, and they've also sent a message of, gradualism, that they're going to go very carefully here. And the way to view this is kind of a vote of confidence in the U.S. economy. And so from the point of view of global markets, I think, there's a big difference between the Fed hiking interest rates in a big battle against inflation, which is very bad for risk assets in global markets, but a Fed that's raising rates because the U.S. economy is healthier is something I think the markets can handle.
Okay, so there is a vote of confidence in the U.S. economy.
I mean, there are still two things that could go against EM basket, and chances of India getting bracketed in that basket remain. So, Ethan, on that note, there are still problems of commodity prices not being able to improve at all. Crude actually inching lower and now, even below their 2008 levels on a few days and a few hours. As well, basically, when it's a rate hike syndrome, you could see some bit of money moving away from emerging market bonds. Equally, for both reasons, how should an emerging market equity investor interpret the next 2 months in terms of fund flows?
Well, I think that there certainly are risks. I mean, when the Fed is hiking, it attracts money into the U.S. I think for commodity producers, this has been a terrible market, and investors really are very concerned about the continued drop in oil prices. But, again, I don't think of this as, a kind of really a bad environment in the sense that, this is not going to be like the taper tantrum of 2013 when the markets are completely surprised by the Fed saying that they were going to start ending their bond buying program. This is more something that we've had a long time to prepare for. It's been well telegraphed by the Fed, and so I think it's it's a little easier to absorb. But yeah, I mean, the general weakness in growth in emerging markets, the fact that many of these economies are sensitive to the commodity markets, that is going to be an ongoing problem. I don't think the Fed is the problem. I do think weak commodity prices is the problem.
Okay. Let me just wind up this conversation with Ethan on what is his expectation of 2016 rate hikes. What's your trajectory, Ethan?
Well, I think that the Fed's going to go very cautiously here. I mean, they're in no rush. Inflation's low in the U.S., and it's not going to rise very fast. And so, the last thing they want to do is undercut the recovery. They're only going to hike as much as the economy and markets can handle. Our view is that they'll probably end up doing 3 or 4 hikes. So that would be either every other meeting or maybe every third meeting. And that would be, and they would hesitate if they saw some real pain being imposed out there. Now, for the global markets, it should be reassuring that the Fed will not push harder than it can be handled. But the Fed's mainly focused on domestic markets. So if we were to get some difficulties in emerging markets, I'm not sure that would be the kind of thing that would slow the Fed down. But again, if the U.S. economy or markets are under pressure, they could go, they could skip a few meetings at a time. So it's going to be slow, 3 or 4 hikes next year.
Okay, so 3 or 4 hikes next year. I'm sure you heard our other speaker, Samir, talking about the improvement in the macros in the Indian markets. Ethan, do you track India, and what would your view be now?
Well, I'm not the specialist in India, but, it's one of the emerging market economies we're more optimistic about. That's what I would say.
Oh, right. Ethan, thanks a lot for joining us this morning.